Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, your tax strategist and recovering spreadsheet enthusiast. Today, we're decoding business partnerships so you keep more profit and sleep better at night. Partnerships are flexible, powerful, and unforgiving when you miss a rule. Subchapter K of the Internal Revenue Code sets the engine. Learn it, or hire someone who speaks it fluently. In this solo session, I'll cover structure choices, agreement design, capital and basis, debt, profit splits, self-employment tax, fringe benefits, deductions, depreciation, interest limits, the qualified business income deduction, passive loss traps, distributions, equity compensation, exits, step-ups, multi-state wrinkles, compliance, and 2 case studies. Grab coffee and your operating agreement. We're building a financially savvy alliance that is tax efficient and dispute resistant. Let's start with structure. A general partnership is simple and cheap, but every partner is fully liable for business debts and for each other's actions. A limited partnership adds limited partners who generally have liability protection, while the general partner remains exposed. An LLP protects partners from each other's malpractice, popular with professional firms. The workhorse is the LLC taxed as a partnership, giving liability protection and maximum flexibility. For tax, all roads here run through Subchapter K. It governs allocations, basis, distributions, contributions, and exits. Your state law entity impacts liability and governance. Subchapter K dictates how income and cash move for tax. Choose a structure that matches liability tolerance, investor roles, and administrative needs. Then draft the agreement to harness K's flexibility deliberately. Next, build a tax-savvy partnership or operating agreement. Track capital accounts using tax basis or book basis with 704B maintenance and state the method. Define allocation methods that have substantial economic effect under 704B. Target capital, layer cake, or traditional. Create a clear distribution waterfall. First to return capital, then preferred returns, then split residual profits. Bake in 704C. Rules for contributed property, revaluation mechanics for new partners, and minimum gain chargeback language. Spell out buy-sell terms, valuation mechanics, and funding sources so no one negotiates angry and broke. Require timely tax information, elections authority, and a responsible partner. Detail tax distributions to cover partners' estimated taxes. And always align economics, capital accounts, and allocations, or the IRS will realign them for you. Initial contributions matter. Cash is easy. Book equals tax, no surprises. Property is spicy. Contributing appreciated property is generally tax-free, but the built-in gain is tracked under Section 704C. When that property is sold, the pre-contribution gain is allocated back to the contributing partner, ensuring the right person pays tax on past appreciation. Pick a 704C method in the agreement. Traditional with curative or remedial allocations are common. Also address contributed liabilities attached to property because they can shift basis and economic risk. If you contribute lost property, built-in loss rules may limit allocations to prevent abuse. Before dropping assets in, model the exit paths and who bears future tax so your economic deal survives contact with reality under IRS scrutiny. 3 ledgers drive your outcome: capital accounts, tax basis, and at-risk amount. Capital accounts record economic arrangement for 704B, allocations, and liquidation rights. Tax basis determines whether you can deduct losses and whether distributions are taxable. At-risk rules further limit loss deductions to the amount you truly have at stake economically. A partner's tax basis starts with contributions, plus allocated income and share of liabilities, minus distributions and allocated losses. If your basis hits 0, additional cash distributions become taxable gain and losses suspend. Track outside basis by partner, not just book capital. Tie your books to K1 reporting and reconcile annually. If you only watch capital accounts, you may miss basis cliffs that turn friendly cash into surprise taxable gain quickly. Debt can fund growth and basis. Partner loans directly to the partnership increase that partner's outside basis. Third-party debt splits 2 ways. Recourse debt is borne economically by the partner who would ultimately pay if things go south. Their share increases their basis and at-risk amount. Non-recourse debt is secured only by property. Partners get basis, but usually not at-risk amounts unless it is qualified non-recourse financing for real estate. Allocation of recourse debt follows economic risk of loss. Non-recourse generally follows profit sharing unless the agreement specifies otherwise. Get the debt terms, guarantees, and indemnities in writing because these details drive basis. Before year-end, smart partners use debt placement and paydowns to manage basis, distributions, and deductibility of current losses. Profit splits are allocations of partnership income. Guaranteed payments compensate a partner for services or capital regardless of profit. They're deductible by the partnership. Ordinary income to the recipient, not eligible for qualified business income, and generally subject to self-employment tax. Partner draws are just distributions, not wages. To boost tax efficiency, favor profit allocations over guaranteed payments when economics allow. Case study: 2 owners paid one a fixed guaranteed payment of $100,000 for management. By reducing the guarantee to $40,000 and allocating more profit tied to performance, total QBI increased, the wage-like piece dropped, and cash still tracked value created. We monitored self-employment exposure, adjusted estimated taxes, and improved after-tax cash flow without changing the deal's economics. Self-employment tax trips many partners. General partners and most active LLC members owe it on their distributive share of trade or business income and on guaranteed payments. The limited partner exception can shield distributive shares, but not guaranteed payments for services. Use cautiously and document roles, because the IRS dislikes facts that look like wages by another name. Planning includes splitting return on capital from pay for services and considering S-corporation blockers in certain cases. Fringe benefits differ from employees. Health insurance paid by the partnership is deductible, but the cost is included in the partner's income and then potentially deducted above the line. HSAs can be great. Retirement plan contributions flow through the K-1 and are limited by earned income calculations. Expense deductions done right start with documentation. Use an accountable reimbursement plan so partners submit receipts and business purpose, and the partnership pays or reimburses directly. Unreimbursed partner expenses can be deductible, but only if required by the agreement and not otherwise reimbursable. Home office, vehicle, travel, and meals require contemporaneous logs and receipts. No shoebox magic in an audit. For depreciation, choose Section 179 when you have current income and want control, but remember taxable income limits and potential state differences. Bonus depreciation is automatic unless you elect out and can create losses, which may or may not help depending on basis and passive limitations. Map purchases to projected income, QBI, and state rules before year-end for maximum punch and clarity. Interest expense has rules under Section 163J. Many small businesses are exempt if average gross receipts stay under the inflation-adjusted threshold. Electing real property trade or business can avoid limits, but requires slower depreciation. Model the trade-off. For the qualified business income deduction, watch wage and unadjusted basis limits, lower guaranteed payments, and consider aggregating commonly controlled businesses to maximize W-2 wages and assets. Passive activity and at-risk rules still apply. Group activities thoughtfully to match income with suspended losses, and consider real estate professional status if you qualify. Documentation is king: hours, roles, and elections. Poor grouping locks losses away. Smart grouping frees them. Coordinate QBI planning with passive rules so one does not undercut the other. Distributions come in flavors. Current distributions return cash or property without fully closing the account. Liquidating distributions wind up a partner's interest. Cash is generally tax-free to the extent of basis. Exceed basis and you have gain. Property carries basis and holding period, but watch hot assets under Section 751. Unrealized receivables and inventory can generate ordinary income on certain distributions and sales. Admitting new partners raises valuation and allocation questions. Compensating with a profits interest can be tax efficient if structured and documented. A capital interest is taxable compensation. An 83B election matters when there is vesting and you want to lock in value. For retiring partners, Section 736 governs payouts, structure for clarity, and predictable tax. On a partner's death or sale, hunt for a step up. A Section 754 election gives the buyer a Section 743B adjustment, boosting depreciation or trimming gain. Case study, a partner bought an above book. We elected 754, recorded step-ups and depreciation sheltered income for years. We flagged multi-state exposure, a tight compliance calendar, and red flags. To close, we covered structures, agreements, contributions, basis, debt, profit splits, self-employment tax, fringe benefits, deductions, depreciation, interest limits, QBI, passive rules, distributions, equity grants, exits, and step-ups. The value: fewer surprises, cash flow, and fewer fights. Work with a pro, update your agreement, and let your books tell the truth. Thanks for listening to Tax Smarts Unlocked.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.